Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm the Senior Trader at the Forex Super Model, and this is Trading Psychology Series Part 8, how to use a trading journal. Now, a lot of you are using trading journals, and that's to be applauded, but are you getting the best out of them, and are they actually doing you any good in the trading process? So what I suggest is we look at the overall process and then talk about whether they're doing you any good and the benefits and so forth of trading journals. Now, what is a trading journal? Well, it's actually it's the process of documenting trading, really, isn't it? So it's the process of documenting trading, your trading to be precise. Right, so it's the process of documenting trading, and what is the process then? Well, it can be broken down into sort of a series of events, if you like. Now, the first phase of trading, if you like, for most people, will be some form of analysis. So it'll be analysis, and that is a whole area in itself. But basically, it will come down to technical, fundamental, and sentiment style analysis. So somewhere in there is probably what you're doing. So you've made some analysis, and then you come to a decision. So a decision is made. So a decision is made, and this decision will be probably of a binary nature. So you'll be deciding to go either long or short in the market. So you've made some analysis, you've come to a decision, and this decision suggests either a long or short trade. Now, the next phase will be you'll be looking for an entry. So you'll be going for your entry, and the entry will be based on your style of trading to a degree. It'll be based on normally it'll be based on indicators or flow data, whatever. But you make an entry, and then you're up and running. So the trade's live, the screen's flashing, and away you go. Now in this process, part of this analysis process would have been a trading plan. Okay, so the trading plan will be sort of all-encompassing, if you like. And the trading plan will basically take the form of normally part of this situation, which is an entry, an exit, and a stop and a take profit, if you like. So that's all part of the trading plan. Now, so the trading plan sort of blurs the process, if you like. So we've got an entry, and then we go into sort of a monitor phase. So we'll be doing some form of monitoring. Even if we decide just to walk away and leave it to its own devices, that's a decision we've made in terms of monitoring. So, or we can micromanage the trade and look at it sort of second by second. So that's the other situation. So we've done some analysis in the overall envelope of the trading plan. We've made a decision. We've got an entry, and we're monitoring the trade. And then we're looking at, as I said, we're looking at either risk management. So we've got risk control, which most people think of as stops, and then we've got TP, take profit, which is the other side of it if the trade goes your way. So the process is developing now. A number of outcomes can happen. We can be forced out of the trade via our risk control. So that can happen. We can be forced out, or we can take a more proactive view and actually take the trade out ourselves before it reaches this risk control, or likewise with the take profit. So we can have some sort of input, psychological input into the process as well. And then ultimately we've got a debrief. Which is basically where the journal comes in. So now most people, and we did this originally and we decided that it wasn't worth the effort, is that the majority of the journal ended up being here. It ended up being the analysis, the decision, the entry, the monitoring, the risk control, and that is all a massive amount of documentation and effort, and it doesn't really take you that far. What the journal should be about is about the debrief, and well, let's get rid of this then. So your journal, which is documenting the process of trading, should be about the debrief. And the reason it should be about the debrief is because it needs to answer one fundamental question, and the question is, what could, should we have done differently? That's what it's all about. What could we have done differently, and what should we have done differently? And that's obviously subjective. Now, in economics, when I was studying that a million years ago, we used to say there was two types of statements. There was either a normative statement, so-called normative statement, and a positive statement. So a positive, normative statement was based on opinions and sentiment, if you like, and a positive statement was based supposedly on facts. So that was, in a way, so most people write up their trading journal from the positive. They do it from the facts. We entered at 1.3029 and we exited at 1.3024. We therefore didn't hit our etc. It's a positive style statement and document. But that doesn't really help you the most. What helps you is the normative end of it, the opinion and the sentiment, because this is going to help you answer what should I have done differently in the process of the trade. So let's make some room here. Now, what we're really talking about then is making a situation via our trading journal where we can make change. So we're looking at forms of change, so types of change. Types of change. Now, we need to change if we're not happy with our current performance, and even if we are happy with our current performance, that performance may change over time, and we need to keep up. So if you look at types of change, now in the business world, they've got this off to quite a fine art, and if you look at types of change, then you've got initially you've got incremental change. So incremental change, and this obviously is, we're now going to refer to our forex trading in this way. So you can make very small incremental changes, which may not seem much, but in over time and in a grander scheme will pay dividends. So examples of incremental changes may be something as small as getting your watch list sorted out so you can see quicker and clearer, speeding up your analysis speed, or something like that. Incremental change, then, small steps which lead to the greater good. Now, the next level of change is step change. So step change, or step changes. Now, called that because they look like steps. So this is maybe where you are now. So this is current, and then you move to the next step. So they're bigger changes. They're more forthright. Then incremental are minute steps, if you like, and step changes are normally viewed as more significant. So once you've made a step change and you're now operating at this step, and then you can make another step change and operate, and so on and so forth. So that's the next level of making changes. Right. So incremental, step change, and then if you really want to shake up your whole process, you do in business you do BPME, which stands for business process reengineering. Business process reengineering. Now, this is where you decide that the whole thing is unsatisfactory, and you go back to the drawing board, as it were, and you basically redesign the whole process. So if it was a factory, you might change the machines and the whole input-output process. Whereas in Forex, the business process, you may, an example of that might be, an extreme example might be you go from being a day trader to a swing trader, or something like that. Anyway, business process re-engineering. Now, if you're at that stage, then presumably you're very not happy with your current performance, or you decide that whilst I'm doing all right, I could be doing better. And so you really want, it's a big shake-up. It's the most abrasive form of change, if you like. And then sort of linked in with this is the final thing, which is this so-called continuous improvement. Which effectively is what a lot of people think they're doing when they're writing a journal. So the idea of continuous improvement, quite often linked with the rise of the Japanese economy, because they took this on board and they looked at every single aspect of their business processes, and they continuously tried to improve them. So they didn't say, well, we're making these well, that's it. That they incentivized the workforce as well as management to actually think of ways of doing things better. Everything was continuously, or tried to be continuously, improved. So that's relevant to our trading journal in a way. The first thing to take away then is are we just writing up positive statements that if you look at your trading history, you can more or less see anyway. So are we wasting our time just going doing that? We need to move to a more normative approach, which is how to use trading journal in terms of what can we do better in terms of change, because this is what it's all about. And then we need to think about the 4 types of changes. Are we going to incrementally change our process? Excuse me. Are we going to have to use step changes? Are we going to have to throw the whole process out and start again? Business process re-engineering. And finally, once we're up and running, are we continuously trying to improve the process? Now that's the sort of the change element of it. Now let's just get rid of this. And this really ties in with what we do. We do a daily briefing, and then at the end of the week we do a weekly review, which is effectively our trading journal, because we conduct what's known as a variance analysis. And a variance analysis is basically you look at the inputs and the outputs, and you see what variance there is between your suggested or your predictions and the actual outcomes. Now, effectively, as I said, a trading journal is a form of a variance analysis, but a lot of people will get bogged down in the positive end of it, just documenting stuff which is quite often unnecessary. What you need to do is to get to the core of it. You need to say, what can I do differently? Why was this different to what we thought was going to happen? And if you're stopped out, then that's a form of variance analysis as well. If you take profit and the market runs up, and you only got like a very small fraction of the move, then that would be an example of a variance analysis. Could I have stayed in? Did it make sense to come out of there, etc.? It's the coulds. Now this then leads on to the sort of the trading psychology end of it. So the psychology, and we're looking at biases really. Now biases is a large area, and we're not going to run through all the biases in this video. We're talking about trading journals, but the gist of it is that your trading journal should flag up or highlight any particular biases that you have in your trading or in your process. Now, the other thing is it will show patterns. Now, so patterns in behaviour. Now, do I always stick a trade on with the intention of leaving it to hit either the stop or the take profit, and then do I always interfere and muck about with it and to the detriment of the trade? That could be a question. So that could be a pattern of behaviour for me. And that could link in with some sort of psychological bias, which could be fear of loss, or any of these biases, fear of missing out, fear of loss, etc. So patterns of behaviour, is what we're looking at. Now, you need to be aware that your trading journal is not a static document. It has phases then. So phases of the journal. And that's why a lot of traders talk about their trading journey, if you like. I really don't like that. It's a bit sort of new wave for me. It's a bit wishy-washy. But what is a trading journey? It's basically phases of your behaviour over time. So just understand that this is what you're trying to recognise. At what stage in my trading process am I? Am I early stage where I'm making you know, a million mistakes, putting short trades on when I should have put a long trade on, or putting way too large position sizes on? You know, am I at the sort of the dozy stage of trading, or am I a bit further advanced? You know, and am what type of analysis am I doing, etc. So your trading journal will be linked with phases, you know, and it'll have a life cycle, if you like. So you'll have an intro phase where you're excuse me again, making all this stuff. You'll have a growth phase, a maturity phase, and hopefully you won't have too much of a decline phase. Excuse me again. And if you do start declining, then you can have an extension strategy, to use the marketing jargon. Right, so that's where we are. Just to summarise then, trading journals, how to use them and how to benefit from them. The starting point is to realise that you're not just documenting for the sake of it. You need to get away from this using your trading as a positive statement, in terms of positive statements. Think of it more in terms of the normative. Think of it in terms of how can I do things better, how can I change. Then you need to think, at what stage in the change process am I? Remember the 4 types of changes. So it's incremental, step, business process re-engineering, and continuous improvement. And then you need to say to yourself, well, okay, I'm there. Is it going to show me some form of variance analysis? And the variance analysis will feed into the psychology and your biases and your patterns of behaviour. Now, so you almost need to keep a journal of your journal, and the journal of your journal should be very short. It should be, I mean, in fact, the trading journal itself shouldn't be too long, because the longer it is, the less likely you'll keep it going, and the more a case of it is just going through the motions. So your journal of your journal should be straight to the point, really. It should be, you know, almost give yourself a mark out of 10 of where you want to get. So, and that will highlight where you're going. So I hope that was useful. Give it a go. If you're just documenting everything that moves, then you probably might want to rethink. So thank you very much.